Another one video, hopefully won't get too windy on this one, but the main theory behind this is you need some kind of macroeconomic theory behind your investment strategy. Without some kind of big picture guesstimation, and that's all it is. And it's educated gambling is all we're doing. We're counting cards at the blackjack table. You're just trying to improve your odds of success, your odds of probability, and really that's the best you can do. And if you manage your money right, hopefully everything turns out okay. And nobody has a crystal ball. Nobody can guesstimate the future, but if you know certain things to look at, you can at least get a little bit of a heads up if something is starting to wane down the wrong direction. So from what I've learned and I learned this from a Goldman Sachs mentor, he says nearly every Goldman Sachs hedge fund manager is trained how to utilize, it's called an Institute for Supply Management, ismworld.org is the website. Go to that. It's going to bring the home page, and you're going to go to the Supply Management News Reports. Okay. After you click that, it's going to drop down. You're going to select this ISM Report on Business. That drops this down. The PMI manufacturing is the most important. Okay, so you're going to view this report. You have to agree to their whatever, saying you won't, share the data or whatever. This is an index number, and as long as this number right here is below 50, you're on thin ice of a possible recession. From what I've understood, from what I've heard from a guy I follow on YouTube, his name's Raoul Pal. He says you get down, below 45, 44, that's pretty much recession territory. So we got really close to that, if not right at that, in 2022. I think we've started our way back out of that. That's, I'm not 100% confident on that. But so this report comes out, it's reporting December's data. This is the last report. They reported in January, 1st of January, on December's data. And so you go through here and read this, it registered a 47.4, and that's 0.07 percentage points up from the 46.7 previous in November, right here. So at least we're going in the right direction. We're going up. Okay, so that gives you a little bit of confidence. We're not quite out of the woods yet, so to speak, but at least we're not going backwards. We're not going further down. Okay, now your next thing you want to read here is out of the 6 biggest manufacturing industries, none of them showed growth in December. So that's a problem. There could be some seasonality to that. A lot of times, after everybody's already cranked out all their Christmas order stuff, most time you're not going to start cranking back up till February, March. You have the Chinese New Year in February. They've pretty much shut down the whole country for the whole month of February. So you can literally go through here and read what they have to say. This is a free website, free to the public. It's been in business since the 70s out of Tempe, Arizona. And, just read, go through and pick it clean, literally it lists which industries. You look for keywords like strong growth or, or bad words, negative, like they're going to holding off interest rate changes, anticipating, Federal Reserve holding off on interest rate changes, overall order intake has picked up. That's positive over last quarter. This is chemical products. Now, they won't say which CEO is saying this, but they're interviewing the CEOs of these companies. Demand is up across the board for transportation equipment. Commodity costs are decreasing. That's food and tobacco. So you can kind of get an idea just off of that which industries might be leading in the next quarter or two. Now this says right here the only industries report growth in December is primary metals. Okay, so that's your iron, I guess, your steel, possibly your gold, silver. Your 16 industries that had contraction, that's non-growth. Printed related activities, apparel, leather. They list them, I think, from the strongest to the weakest on this. I know if you had positive growth, they definitely list these up here from the strongest to the weakest. So that's an easy way to tell which industries are doing the best in the United States anyway. But I believe this is all based on United States only industries. I'm not 100% certain on that, but fairly certain. You come down here, aluminum, propylene steel, cold rolled steel, commodities that are up in price. Commodities down, you have copper products, corrugated, crude oil, diesel, natural gas, packaging, stainless steel, steel products. Commodities in short supply. Now this could create a price spike just out of supply and demand. So you have electrical components, skilled labor, semiconductors. They're still short supply. Number of consecutive months, the commodity. So just go through all this and kind of find the new orders is really important. If you have an industry with a lot of new orders, that helps a lot. That's growth. For manufacturing industries that have growth and new orders, you have textile mills, primary metals, miscellaneous manufacturing, and chemical products. So that at least gives you an idea that those industries are at least seeing some new orders coming out. Your production, you want to follow, if your production's up or down. Employment, you're going to have skilled labor problems, for a while. Supply and deliveries, are they able to get the product to the customer? Your inventories, you don't want really high inventories. If you have high inventories, that indicates they're not selling their product. They're having to store too much in their storage. Customer inventory prices. Your price index registered 45.2%. That's 4 percentage points lower. So that's kind of a heads up on your inflation right there. At least the price index, the material price index for the businesses is 4% lower. So that's good. At least that should help a little bit. Your backlog orders, they gained 6 point gain. So you got more backlog. Export orders, that's higher. Export orders is good. Imports, there's an increase of 0.2 on imports. So this is just a pretty good overall, physical on the economy to tell you how strong the current economic situation is. The next report's going to come out February 1st, 2024, 10 o'clock Eastern time on a Thursday. So, you can set you an alert on your calendar, set you an alarm on your phone, and be the first, one of the first ones to read this. And, it just kind of helps you go over everything. I think keep an eye on it. But so if you want to chart this on TradingView.com, they have, you type the ticker symbol right here. It's USB, as in boy, COI. And you can read, it reads United States ISM Purchasing Manager Index PMI. It's on a monthly chart by default. And it literally, you can put a trend line if you want to on it. I do. I put another horizontal line at 50, so I know when this crosses below 50, we're on thin ice, and until we get back above 50, you can tell on previous data. If you go back here to 2008, 2009 data, we crossed below it right here. That's when we entered the recession. You went below it briefly, it went right back up, and then when you shot back down the second time, it was, that's when all the house of cards collapsed. Again right here in 2000, 2002, 2001, for that recession. Same thing. We're kind of in a channel right here. If you go from the low to the high right here. So theoretically, we hit the low right here in 2020 during COVID. We could come down and hit this 45 again. I hope we don't. According to a pretty smart guy that I follow, he doesn't think we're due for a recession until most likely 2027. He could be wrong, could be right. I don't know. According to this, we're not out of the woods yet. I want to see this back above 50, ideally sometime this year or next year, before I, feel extremely confident investing in long-term in stocks. But you can still time it. You can get your 90-day or 6-month trades, on whatever you're trading. But you just got to have this in the back of your mind to be careful. You might even reduce your bet size a little bit on stocks, especially, or crypto for that matter, or your 401k. We could still see a blow-off year. We could see, record profits, record highs on the S&P and the Dow Jones and NASDAQ. Who knows? Most likely being an election year, they're probably going to prop it up, try to make it look good. They're probably going to reduce energy costs to try to help inflation. That's another thing that a mentor recommends is watching inflation rate. And he says when inflation gets above 5%, you usually want to head towards the door pretty soon on stocks. You want to take profits. You missed it by about 6 months. You got above it in June of 21, and you topped out, technically June of 22. That's what that says. Well, your stock market topped out in December, January of 22 is when it topped out. I can pull that up on a chart for you if you want to look at the Dow Jones. Right here was your high, January of 22. It made just a little higher high. Technically, you could just say December of 21. It rolled over the very next month. You made a little higher high, I think early in the month, and then you just sold off for pretty much all year after you got above that 5%. So you missed the top by 6 months, but you also missed a pretty sizable drawdown on your account if you got out anywhere near this top. From the top to the bottom, it dropped 22.44% on the Dow Jones in 2022. So just keep that in mind. Your inflation really plays a big factor. Your mortgage rates, there again, they have come down off of 7% or whatever it was, back in October of 23, but you're still above 6%. I don't know. In my personal case, I don't really want to buy anything at those rates. You can watch the Goldman Sachs Commodity Index, see what commodities are doing. I like watching the bonds. If you'll watch bonds, that's TLT, is the 20-year Treasury bonds. So you go back on a monthly chart back in 2018, November of 2018, you see the price action went nearly straight up until March of 2020. So when you see the bond market doing this, that's the smart money getting out of stocks and they're getting into something safe and relatively low volatility, like bond. They love 20, 30-year bonds, or at least a 5-year bond when it's high risk time. And I can almost guarantee you the elite people that pretty much run the country and the world, I'm pretty sure they knew COVID was coming. You don't see a bond run up like this very often if there's not some kind of economic problem coming up. Most likely. Now you had some more over here. You could go all the way back. This only goes back to 2002, so that really wouldn't help you as far as the 08-09. It did it again right here. As of July 07, pretty much June 07, almost straight up. You pull back a little, but you really got high during the crash times of 08. It finally started selling off into the spring of 2009. That's when you finally bottomed out in March of 09. But so you can pretty much watch that. Watch your unemployment rate. Larry Williams says usually when you get above 9.5% to 10% unemployment rate, that's getting pretty close to the bottom of your recession. If you look where it was in 2009, October 2009, you topped out, I believe it right there at 10%. Looks like to me. It says your indicator right here. I think that's right at 10%. So now March was the low in 2009. So, let's see, February, April, March. You were up around 8.7 then. So you were pretty close to your 9.5. I think you could have watched your ISM in 2008, 2009. And once you started ticking back up, definitely once you get back above your 50, that was July of 09. But, you see here this was December of 2008. There's January, February, March. So it went up 3 or 4 months in a row. So that's a pretty good indicator. You got above your 4-week or 4-month moving average right here in March of 2009. That could be an all clear. If you went through 18 to 24 months of recession, most likely you're getting close to the bottom. That's the average duration of your average recession. Usually you're going to drop anywhere from 50 to 80% on your stock prices from the high to the low during a recession. So you could kind of time it that way a little bit too. You watch your housing prices. It bottomed out 2012. My wife and I timed it just by dumb luck. I didn't even know how to look this up back then. We bought our house in 2012, February 2012 actually. Couldn't have timed it any better if I would have had a college degree. And we bought February 2012. It was pretty much the low. Might have made, I think it went up a little bit in March, 134.08. No, it went down just a little bit more in March, and then it started ticking up in April of 2012. I hit a home run on that, I thought, but we missed the top by a little bit. We sold 2020. I probably should have held at least another year, 6 months. I could have made another 50 grand on our house when we sold it, but I wasn't watching this that close. I didn't even know you could chart it. Actually, I don't think back then on this TradingView. I just started kind of playing around with TradingView. Didn't even know how to use the alerts back then. You can't do it on economic stuff, but so there's your inflation rate. Right now we're below 5% at least. We're at 3.4. A lot of them are thinking we're going to be kind of sticky around this 3%, 2.5%, 3% for it may go sideways for a couple of years. So just keep an eye on that. Your United States PCE price index. That's pretty important. That's a measure of inflation. How much your commodities and whatever that your businesses have to buy to produce goods and services. At least that has come down quite a bit. I don't know what percentage. Let's see, from there to here, it's about almost 5%, 4.5%. So that's better at least. It's going the right direction. You can also watch this WM2NS. This is the Federal Reserve money supply. If you'll Google M to M Fed and come down here on St. Louis Federal Reserve, click that and go to a 1-year chart. You can see since October of 23, the Federal Reserve has been pumping money into the stock market, most likely, or into the economy. You can see back here, April 23, they did the same thing. In the summer, they kind of pulled money out of the economy. They were probably selling stocks and bonds on the stock market. That's a lot of reason why a lot of times you see a dip in the stock market. Same thing, and since October, you can look at a chart of the S&P. Just type in SPY. That's your S&P 500 mini. Let's see what it did since October. Let's see, October. There's October. Pretty much straight up, right there. That tells you. It's really as simple as that. If you'll watch the money supply coming out of the Fed, that's a pretty good indicator of which way your stock market is going to go. Most stocks are going to follow. 75% of your stocks are going to follow what the S&P and the Dow Jones are doing. So, unless they have a really bad news event for the day, as long as your S&P and your Dow Jones and NASDAQ and Russell, if all your indexes are up, most likely your stock is going to be up that day too. Unless you have a bad news event that's, going against you. Just keep that in mind. That M2M money supply is really a good thing to watch on a monthly, at least quarterly basis. I'm not 100% sure how often they update it. There's January data, December data. So it's about a monthly data that comes out from the Federal Reserve. Your building permits data. There's another thing. You can Google building permit data. Come down here to it's tradingeconomics.com, United States building permits. I learned this from the Goldman Sachs mentor guy. He taught me how to do my own chart, but it was really time consuming. So I finally found this website that does it for free. So you don't have to, make an Excel spreadsheet to make your own chart. You can go to this forecast button, and it's literally a forecast that, this is the houses they're going to be building this spring and this summer should be going up until, a little past July, maybe August, tops out, may sell off, may roll back over. A lot of that seasonality, if you go to your building permits data, it's USBP over here on TradingView, you can chart a lot of this stuff. Like I say, it is trending up, so that's good for the economy at least. And if you look at copper prices, you can type in HG1, I believe. It's HG1 exclamation point. That's copper futures. And so far, copper's been trending up too, and since July of 2022. So as long as, from what I understand, as long as you have trending up copper, that's relatively bullish for the economy. So you have to have a strong copper market. If you don't, most time your economy is going to struggle. You can see over here, we broke this trend line over here. Let's see, let's put this trend line on it. Let me see exactly. Yeah, probably. So right here, this was a red flag, July of 2019. Had we have known, to pull this up, you could have had a heads up on COVID, 6 months in advance. When you saw this break of this trend line, at least in August of 2019, now it did reclaim it briefly, but then the very next month, January, you lost it. And then February was when, everything hit, come crashing down. Same thing over here. 2015 or whenever we had a pretty weak economy. 2015, 2016, it was pretty rough. Low prices. 2016, finally bottomed out, started back up. So keep an eye on that. That's a long term. That's all the way back from March of 2020 trend line. So if we lose this trend line right here, that's a major problem in my opinion. That's you probably get rid of this one. I'm gonna get rid of that. This is a short term trend line. If you lose that, if you lose this one, that's a problem. We did break above this downtrending cycle right here in the last month or two in December. So that at least gives you a little bit of confidence that the economy is strengthening somewhat. The only thing that kind of bugs me is the loaded rail cars. You can Google loaded rail car data. This measures your loaded railroad cars. I believe it's St. Louis Fed data. So it should be United States and the USA loaded rail cars. If you notice on the data, right now where we're at is below 2009 levels, May of 2009. So that doesn't give me a whole lot of confidence. I mean, your railroad loaded cars is a leading indicator also to your current economic stability. So now it has traced up a little since October of 23. I'll give you that. At least it's not going down. We lost, a previous high in September of 23 going into October of 23. That, scared me a little bit. It worked out. Could have just been seasonality. Your August was pretty low in 23. You did peak up a little. That's probably ramping up due to the Christmas holiday. They start shipping stuff 3 to 6 months out, for Christmas. Your Walmart, all your stores, they start stocking up for Christmas way early. But so I would definitely keep an eye on this. Now, like I said, there is some seasonality to it. But ideally, I would like to see that get back above these 2009 levels, hopefully within the next year or two. If not, that's a major problem. You can see right here, this 2016 was another low point. They called this a mini recession, is what I had one mentor at the time I was learning options from, and that's what he called it, was a mini recession during 2015-16. And I do remember it was a hard time to make money on the stock market. I was trying to learn options, and I took a beating that year. I was up like, I don't know, $2,000, $3,000 midsummer. And by the end of the year, 2016, I was down, I think, $2,000 or $3,000. So I gave up all my profit, and I should have been paper trading. I should have been trading with real money, but I got impatient, and I broke my own rules. But so you got to watch that. Obviously, during March 2020, May, that was a bad time for everybody. But so we get back, these kind of levels. That would be really bad. But hopefully we can maintain, the lowest low point since then was December of 22. I wouldn't really want to see us go back below that. Ideally, if as long as we can stay above that level, I think we're all right. But there's one other man right here. This is the guy right here, Larry R. Williams. Probably one of the smartest guys on the planet. 61 years trading experience. I highly recommend read all his books. He has a forecast that he puts out. You go to his website, it's ireallytrade.com, and he really trades. He's in his 80s, and he still trades commodities almost daily. Go to reports, and there's an annual forecast, okay? Now, you'll have to create an account or whatever to be able to buy it, but he literally gives you a roadmap of future price action 12 months into the future for the whole year of 2024. And he predicts, all the commodities, probably 40 or 50 different stocks. I don't know. He does all the Berkshire Hathaway stocks. He does Berkshire Hathaway B fund, the B stock. He does Tesla, Apple, Google, Netflix, NASDAQ, all the S&P, the Dow Jones, he does all the commodities, gold, silver, he does Bitcoin. He does inflation rates. He does the dollar index, all the currencies. I don't know. It's based on a cycle. It's based on a time frame of a cycle. I wish I knew how to do it. But this guy, you can go through and read his report, see what he did last, in 2022. Pretty much nailed it to the bottom. October was almost to the day of the bottom of this thing. Straight up. This was his forecast in blue. This was the actual price action on the Dow Jones. Nailed it almost to the day. That literally blew my mind how close. And he predicted this December of 2022, predicted what it was going to do in October of 2023. So, I don't know anybody else that can do this and be that close and that accurate. Now, he might miss it by a week or two. He might be a week early, he might be a week late, but still, that's like Nostradamus crystal ball kind of stuff, man. It's the closest thing to a crystal ball that I've seen. Now, you can't just blindly take a trade off of this. Ideally, you need to know how to read a chart. You need to know how to, time your daily entry. You need to look for weekly setups, and you can improve your odds of success even better. But, go through and read this thing. He's got a monthly cycle, predicting, we could see a little problem going into 2025 after the election. He's seeing that we might dip down until the spring of 2026. That's right off of his website. That's free to the public without even logging in. So I'm not, sharing proprietary stuff. I'm actually advertising for the guy because, he's one of my heroes, man. He's one of my people that I go to. If I don't have a clue what the market's going to do, I go to my Larry Williams forecast, and it at least gives you some kind of roadmap. Now, what he says, it's better if you can get your blue and your red lines going in the same direction. You have a higher probability of a bounce. So like right here, both of them were coming down. You saw a major down action. Your blue is usually your long term and your red is your short term. Now, the big thing he says, it took me like a year, 2 years to figure this out, but it doesn't measure the magnitude of the size of the move. It just measures your time frame, and he always puts your month, down here on the bottom. It measures your time frame of your likelihood of a bounce or your likelihood of a top. Now, he does admit that his cycles call the bottoms a lot better than they call the tops. So, like right here, he missed it by a little bit on the exact top. I mean, it kind of showed right here. This was 22, I guess, of, the summer and the fall of 22. Showed a pullback, and we got it. And then showed a bounce point sometime around October. Seasonality, a lot of times you're going to get a bounce. Most years, about October 25th or so, 20th, you're probably going to get a bounce sometime in that time frame, most of the time anyway. But, you can go through this, and, his Visa forecast, nailed the bottom right here in October. NVIDIA, man, you could have made a home run on this NVIDIA. If you'd have got in October of 22, this thing went up like 300% in 23. Just boomed. It was one of the best stocks of the year. So, here it is right here. There's the Free Rockwell International, ROK, whatever that is. So this year he's actually putting dates, that makes it easier to read, that way you don't have to get a ruler and see, what time frame is most likely to, correct. You can watch a video on it, right here. Highly, highly recommend it. For $249, literally you can make that back in one trade. If you have a 401k, I would highly, highly recommend buying this guy's forecast because it's money well spent, I think. So that's what I use. To be honest with you, I wouldn't be caught without it because it's better than nothing. At least you have some kind of roadmap, some kind of guesstimation of what price action is going to do for the year, So I'll cut this video short. Just keep that in mind. Try to get some kind of thesis. If you have access to this symbolic also, and if you have access to Larry Williams indicators, this tells you right here, if you watch the bonds on the commodities and futures markets, this is a continuous contract on 30-year bonds. As long as your corporate money, your commercial money is not heavily invested, your bonds are probably going to keep going down. So that tells you right here that the smart money is not heavily investing in bonds right now. So that most likely means stocks should do fairly well, at least short term anyway. So that's not really predicting any kind of major economic collapse or any kind of major problem. Like if you went back over here, leading up to 2020 on this, you could have got a good heads up. Let's see. This was, starting about October of 2019, you can see commercial money was accumulating. Now, they never got into the super all-in, indications, but you were getting red flags right here Well, that's pretty much February, so I mean that was too late by then. But um, right? Let's see, yeah, it's February 2020, so the move was pretty much over. But you could have watched your TLT, and that was a pretty good indicator too of what the smart money was doing. Now it could, sometimes you could just be kind of seasonal on your time frames, but seeing your commercial money selling right now, I don't think I'd be invested in bonds right now because I think they're going to keep going down short term for a little while. So just keep that in mind. I would watch oil also. Your copper. Copper's a big, like I say, copper's a big indicator of a strong economy or not. Right now, your commercial money is heavily invested in copper. So I would probably guesstimate the economy is going to keep getting stronger according to that, at least short term, and you haven't even started your up count yet. So I would watch that. Again, over here, you had heavy investing in copper, even during the worst of 2020. They were heavily invested. They were accumulating and buying, and you see what happened as soon as they started printing the money. That's another indication. If you can wait till the Federal Reserve announces that they're going to print money, that's pretty much an all-in signal also. Because as soon as they print money, your U.S. dollar loses value, but all of your assets, gold, silver, Bitcoin, crypto, housing, everything pretty much, even your used vehicles gain value when they print the money. I mean, it looks like you're gaining value, but it's actually your U.S. dollar that is losing purchasing power, is what I've been told, the way I've been explained how it really works. It's only took me nearly 50 years to figure that out, but I'm a little slow, I guess, on learning this stuff. I wish I'd learned this stuff in high school, but I've been a lot further ahead if I would have known how the world really works, at least how the stock market and the global economy works, with inflation rates and Federal Reserve and bonds and interests and all that stuff. It's all tied together. And once you start to realize how it works, it does give you a big picture and kind of helps you come up with a trading, thesis, at least short term anyway. So hopefully this video helps. I don't want to keep rambling on. I know it's, if you do it enough, you start to get a little feel for it. And so you may have to watch this video 2 or 3 times, to grasp it. But, just take notes, bookmark it. If you have to, copy the link, maybe put it in your little note folder on your phone or something, maybe you could title it, macroeconomic, research or something like that, where you can find it easy. So hopefully it helps. Hopefully it'll help us next time foresee a possible recession or economic problem in the future, where hopefully most people can get out before the crash happens. Or if we see, a lot of money coming out of bonds going into stocks or copper or housing or whatever, that's a good indication that maybe we're working our way out of this, and we might be able to have what they call a soft landing as far as avoiding the next recession. So, but we do average a recession about every 7 to 10 years. So that would make sense. If 2020 was technically a recession, which most people are saying it was, then that would make sense that a 2027 would be your highest likelihood of a possible official recession. So just keep that in the back of your mind. We could also see a pretty good sizable sell-off after the election this year, possibly December of 25, January 26. We could see a sell-off pretty much the whole year of 2025 is what it looks like according to that one forecast could be the spring of 26. So just keep that in the back of your mind. I'm going to try to make weekly videos. I track all the commodities pretty much that are, tradable and chartable. So if you'll watch that on a weekly basis, I'm going to try to do that every Saturday if I'm not working. And just that alone will help you realize what the smart money's doing. And if you'll track the smart money, if you'll follow the money, most time you'll be on the right side of the trade. So just keep that in mind, and we'll catch y'all next time.